NY. He specializes in monetary economics and econometrics. He has published research papers in the International Journal of Central Banking, Economics Letters, Economic Modeling, Asian Development Review, Scientific Reports, and PLOS ONE. He has recently developed an interest in health economics and the analysis of subnational economics through satellite data. We extend a very warm welcome to Mr. Chattopadhyay. Please come on the stage. And Neelanjana, our PhD student, is going to present. Thank you. A very warm welcome once again. And please, if you want.
Yeah, you need to see it today.
So, without further ado, we shall invite Mr. Chattopadhyay to deliver his lecture.
So, thank you very much for turning out. Summertime, I know I'm also from another IIT, how it happens, and also it's a very hardcore macro paper. I I do not know how much interest. So I'll try to explain it from the very basic, from our undergraduate ISLM, what we learned and how it actually got developed. And then I will come to our work, where is our contribution and everything. So first of all, again, thank you very much for inviting me to give this talk over here. This is the first time I'm presenting this paper. The paper is finished. Maybe we'll go to send it for publication in a couple of months. Uh, let's see how it goes. The comments will be especially welcome. So bond duration, quantitative easing, and zero lower bound, a behavioral new Keynesian model. It is co-authored by my research scholar Arpan Chakraborty. For last couple of months, he joined this Jain University, and his defense is due in 10-15 days. Professor Mousumi Das from the School of Economics. Actually, Mousumi introduced us with this behavioral theory by sending us some papers, some lecture notes of De Groe. And I also got interested and started working on this particular topic. And Sohini Shahu from IIT Kanpur. This zero lower bound, optimal monetary policy, this is basically my PhD topic. Zero lower bound, we familiarly, basically, it's known as liquidity trap in our undergraduate days, ISLM undergraduate. And the consequence we all know, that if nominal interest rate is zero, an economy is in recession, you cannot reduce the nominal interest rate further down. Conventional monetary policy becomes completely ineffective. It cannot stimulate the economy. So static ISLM, expectation plays no role over there. But when this dynamic new Keynesian model comes in and 2008 crisis comes in, people started thinking about that if monetary policy has any role, even if the nominal interest rate is at zero. So a series of paper actually came at that time, majorly two groups. One group, they said that if you keep the nominal interest rate longer, then it automatically gives some extra stimulus. So this is your forward guidance kind of policy. Egerstein and Woodford, then Adam and Billy, two consecutive papers, they actually have shown is basically how long you are going to keep your nominal interest at zero. That's the optimal point. You are choosing that T till that capital T, your nominal interest rate is zero. After that, it goes out. The result was pretty simple. Commitment is giving me lower loss because commitment keeps the nominal interest rate at zero longer. But commitment is not credible. Standard result. We have some contribution over there. Our International Journal of Central Banking paper, we said that how inflation target can implement forward guidance policy in a simple new Keynesian rational expectation based model. So that is one thing. It's what you're actually doing, you're influencing expected inflation. Your nominal interest rate is zero, your real interest rate is nominal interest rate minus expected inflation. If you can raise the expected inflation somehow, forward guidance does the same thing, keeping the nominal interest rate longer. It is giving a signal that I am going to follow this expansionary monetary policy for a longer period of time. It raises expectation, real interest rate goes down, stimulate the economy. This is basically the channel through which the forward guidance actually works. Another strand of literature, they actually work with this quantitative easing. What is this QE? Quantitative easing is basically from our standard new Keynesian model, you have a IS equation. And if you solve it forward, you will say that expenditure depends on long-term interest rate, not short-term interest rate. So if you can influence long-term interest rate, you can influence spending. In a normal time, this conventional arbitrage relationship between short-term and long-term interest rate prevails. Let's say expectation theory. By simply influencing the nominal interest rate short term, you can influence long term interest rate, and that ultimately influence spending. But when the nominal interest rate is zero, you cannot do it. What quantitative easing does directly influence long term interest rate. How? Through targeted purchase of long term securities. So if you purchase securities, what will happen? The security price will go up, interest rate goes down. Which security? Long term security. So long term interest rate going down, stimulus. This is how the quantitative easing works. And from this channel, it's common sense to infer that how sensitive your interest rate is to the bond price, that matters. If your interest rate is fully insensitive, nothing will happen. So that's the thing. That's the major intuitive way of explaining QE is basically interest sensitivity of price sensitivity of return. And what is the price sensitivity of return of a bond is basically duration. So the common sense says that we should implement QE through higher duration long-term bonds. The bonds who has greater price sensitivity of return, right? That's the starting point. And what the data says, if I go to the US data, this is exactly what data says. Before 2008 crisis, in the portfolio of the treasury, proportion of long-term bond was 25%. This is basically a liability. They're issuing this bond, central bank is purchasing this bond. Long-term bond issued in their portfolio was 25%. Throughout our analysis, we actually define short-term bond is basically whose duration is less than 3 months. And any bond duration higher than 3 months, we consider them as a long-term bond. Following that definition, 25%. And during the crisis period, you see the proportion of long-term bond in the fiscal portfolio increased to 43%. They started doing QE. Duration. What type of long-term bond? Before crisis, average duration of long-term bond was 3.7 years. Now it is increased to 4.2 years. Long-term bonds, higher duration. And alongside that, they also followed an expansionary fiscal policy. Labor income tax reduced from 0.28 to 0.22. This is what data says, and it is perfectly portraying our intuition, price sensitivity of return. That matters. The basic question we are asking that what is the optimal duration? to conduct QE through long-term bonds. And to do that, we have developed this model. So generally, this corporate finance way of analyzing this is they said that when fiscal debt is rising, the treasury wants to insulate their net worth from the interest rate fluctuations. This is called duration gap analysis. And that is why they issue bonds with the higher duration. That reduces duration gap, and interest rate fluctuation has minimal, so that the interest rate fluctuation has minimal impact on the net worth of the treasury. They said they are actually, to explain in a corporate finance way, they said this is happening because they're actually minimizing the interest rate risk through this duration gap analysis. The question we are asking, is it also optimal to do it? It is risk minimizing. Fine, we agree. Is it also an optimal strategy to do it? Optimal means outcome. There should be a loss function. So this is what we are asking. What is the optimum duration long-term bond for conducting QE? And what is the optimum tax rate? Are they matching with the US data? So if I calculate them from our model, we also have to match them with the US data, their moments. That's first question. Is there any change in fiscal monetary interaction for the US pre-crisis, post-crisis, or during crisis? Second, these are all basically byproducts. This is the main thing. While doing it, we got these results, extra results. And does the extent of zero lower bound influence the optimal policy choice? That means suppose zero lower bound is binding for, let's say, 20 quarters. Vis-a-vis, it is binding for 40 quarters. Is there any change in the optimal policy, duration of bond, tax rate? These are the three basic questions we are trying to answer through our model. Now, to do that, we develop this model. The people ask this question that why you are suddenly got interested in behavioral models rather than rational expectation. Actually, is a very nice survey article in J Macro. It basically actually says that, okay, they solve a new Keynesian model through rational expectation and also through behavioral modeling. And they say that there are certain stylized facts in the data which a rational expectation based model cannot explain. And we are already aware of that. First of all, demand shock has a hum-shaped impact on output and inflation rate. If you have a standard sticky price kind of new Keynesian model, you cannot generate that. The distribution of output gap and the inflation rate is non-Gaussian. You cannot generate that. This behavioral model can actually generate this kind of result that matches the data. So both this deGruy, deGruy has a lecture note. If you go through that, you'll get this, and also this interesting paper, survey paper. So what I did, this deGruy and Foresti, they have a 2023 paper in JEBO. We take that model, and what I introduce a Woodford 2001 kind of bond structure over that. That's the only change I made in terms of modeling. And another important contribution is this fiscal monetary interaction. deGruy and Foresti actually analyzed that using their model, but without zero lower bound. So we extended that to the zero lower bound. So that's two major, one from the analysis point of view and one from the modeling point of view. From modeling point of view, we introduce this Woodford 2000 kind of bond structure. Why? Because we will see in a couple of minutes, it has this varying maturity structure. We can model it, we can parameterize it, and then zero lower bound. But the question is, there's a series of paper, especially by Eric Sims, who analyze QE, the impact of QE, stabilizing role of QE. But neither of them analyze what is the optimal duration. Q is helpful, Q is optimal. What is the stabilizing role? Fine. But what is the duration? Throughout their analysis, they actually, this is a parameter, you will come to know, denoted by omega. They have taken some value of omega and they have go for this impulse response function analysis and everything. We are actually asking the question, what is that optimal omega? That omega is basically the duration in a Woodford type bond structure. Let me come to that. Yeah. And fiscal monetary interaction under different policy rule. And these policy rules are coming up from different game theoretic interaction between the fiscal authority and monetary authority. We'll come to that. Frageta and Kirsanova conceptualized this, and they have estimated it for the pre-crisis period for the US and the European Union countries. These policy rules, DeGroe and Foresti 2023 paper, they also used to analyze, if I follow, let's say, a monetary dominance, what is the stability of output gap and inflation rate and the public debt vis-a-vis, if I follow, let's say, a no dominant structure or fiscal dominant structure. I'll define it later. They have done that. We have done the same analysis but extended it in the zero lower bound also. Till now, is it clear? Is it making sense? Okay. Okay. Now the modeling part. Thank you. As I told you that I have not derived this model. The basic equations, demand side coming from IS equation, your Euler equation, supply side, it is the Rotenbach kind of adjustment cost is there in the utility function. This is all actually derived by that DeGroe and Foresti 2023 paper. Shocks over here, IID, supply shock, demand shock. This is demand shock, supply shock. IID, mean 0, variance 0.5, followed this parameter structure also from DeGroe and Foresti paper. The challenge was that how should I introduce this bond structure into the model so that I can keep on using, or this equation 1 and equation 2 still represents the demand side and the supply side of my modified model. I've taken a very simplifying assumption. Bonds, I'm going to show you, it is issued by the treasury. Household does not purchase bond. Household deposits their money to a bank and they earn deposit rate. So this is deposit rate. Short term. And banking sector, the commercial bank and the central bank, they purchase these bonds. With these simplifying assumptions, that does not change our main results and objective, allows us to use equation 1 and equation 2 as the demand side and the supply side of our modified model. Standard Taylor rule, we are very familiar about it. This is your interest rate smoothing, output gap, inflation. I am following standard Taylor parameterization 1.5, C1, C2, 0.5. This is basically the bond structure of Woodford. So, 1 unit of new bond issued today, it guarantees you to deliver $1 tomorrow. So that means NB, number of new bond, is going to deliver NB dollar tomorrow. This is basically, so NBT is the total number of new bond issued by the treasury at the time period T. NBT minus 1 is the total number of new bond issued by the treasury in the period T minus 1. Total debt outstanding of the treasury at the time period T is this. And what is the omega? Omega is basically the decay rate of the coupon payment. This is how it is defined. I'm not going in detail into that. Okay. The most interesting part is of this simplifying bond structure, it does a lot of stuff actually. By simply varying this omega, omega is also parameterizes the maturity or the duration. So it gives me to choose omega optimally in my analysis. That is why this bond structure is used. Omega lies between 0 and 1. 0 is completely short-term bond. And gradually omega rises, duration of the bond rises. So you can actually model short-term bond and long-term bond very easily through this structure by simply varying omega. And another interesting thing is, if you know, generally from the data, we know what is the outstanding debt of a treasury or any particular company or anything. But if you know that, you can easily calculate from this model what is the total number of bond issued. You do not need to know them separately. Just from the debt outstanding, you can calculate it. And also this price structure. So if you know this, in the next period, the price will be omega qt minus 1. So for each and every period, you do not need to calculate your bond price. They have a structure, and it is related with this decay rate of omega through this relationship. That's the nominal return. So if you purchase 1 unit of this bond at the price qt minus 1 yesterday, what will get to get? What you get after 1 year? You get this coupon payment, 1, and you can sell that bond at a particular price. And that's the, and this ratio, we know, it is defined in finance as nominal return. Standard. Not going in detail of that. You set omega equals to 0, it becomes this. And you see the relationship price and the bond return negative relation. Standard, which we know from our undergraduate. This is the log linearized budget constraint of the fiscal authority. Is basically income equals to expenditure of the fiscal authority. The derivation is there in my paper. I'm not showing this over here. It's very easy. Government income, government expenditure, you equate and you log linearize around a steady state. You get this. And this is fiscal rule, very standard fiscal rule. This is how, just like a Taylor rule, how output and inflation allow me to calculate my nominal interest rate. There's a fiscal rule. How last period date, output, They determine current period government spending. Standard fiscal rule. Banking sector, as I said, these bonds are issued by the treasury, purchased by the banking sector. Commercial bank receives deposits, gives the deposit rate, and central bank who purchase these bonds, let's say from the treasury, they also receives interest rate. They have a profit, this banking sector, that basically depends on this nominal interest rate of the bond and the deposit rate difference. Derivation is there in our paper, and they return it to the household so that the model gets complete. There is no leakage. This is basically, I will spend a little bit of time over here because I am actually defining this behavioral expectation formation over here. It's not, I cannot say, it's non-rational actually. This behavioral structure, they assume that you have two types of, let's say, household or economic agents. One, they call it fundamentalists, and another group, they call it extrapolators. De Grooy assumes that fundamentalists always forecast steady state. Since it's a deviation from the steady state, so in our linearized model, it is zero. And fundamentalists, they actually forecast the last period value of that particular variable of interest. Here the variable is xt. So what they're forecasting, etxt plus 1 is xt minus 1. Linearized around the steady state, xt minus 1 minus xss, it is xt minus 1 hat. This is the simplest behavioral model. Later, he extended it with the multiple agents also, who had who is forecasting, let's say, xt minus 2, some proportion is forecasting xt minus 3, extended that. And aggregate expectation, this et tilde, is basically the weighted average of the forecast of the fundamentalist and the extrapolators. The key here, how do I determine this? These weights. What is the proportion of fundamentalists in the economy? What is the proportion of extrapolators in the economy? We know the sum of them has to be equals to 1. So if we can calculate one of them, we can calculate the other. And for that, keeping that data thing in mind, that property of the data, that distribution of output gap and inflation rate is non-Gaussian. What de Grooy prescribed that they are actually getting calculated from these two equations. Let me explain one by one. Let me come to this slide first. This is your forecast, right? And this is the actual value. This is the forecast error. So you are determining some sort of measure UFT, de Grooy call it utility of the fundamentalist from here. And we all know this for fundamentalists, this is basically XSS, or it is basically XSS hat is basically 0. So for fundamentalists in our model, it's 0. So each and every period, the fundamentalist is forecasting steady state. Fine. Obviously making some error, forecast error. And that forecast error is determining a measure called UFT. This is a memory parameter. For how long you are, when you are calculating your UFT, the fundamentalist welfare, forecast error for how many years or how many quarters you consider. That depends on this. And it is basically calculated in this fashion. Rho lies between 0 and 1. Parameter value I have taken from de Grauwe paper. So if it is 1, de Grauwe has shown that the impulse response of this behavioral model matches very closely with the impulse response of rational expectation model. These memory parameters matters. Similarly, for the extrapolators. So what de Grauwe said about it, that this, I do not say that these people, they are not rational. They are rational in the sense they are not omniscient. They do not know the entire structure of the model. They make mistake, but they correct it. So they have a cognitive limitation. They make mistakes, but they correct it. In that sense, they are rational. Once you calculate this, you substitute them over here. The logistics distribution. So proportions will be calculated. Proportion of fundamentalists, proportion of extrapolators. The way we have defined this, if the fundamentalist is making more and more mistakes, this goes down. As soon as your UFT goes down, this goes down. Fundamentalist, I'm making mistakes. I'm no longer fundamentalist. I shift to extrapolators. And this shifts happens continuously depending on your forecast error. And that creates, so this is a willingness to learn parameter. I'll come to that later. So this shifts continuously happens each and every period. And based on that, just simply using a balanced statistic in statistics or econometrics, they calculate a measure of market sentiment or animal spirit as the difference in this fashion. So as these are endogenously determined, the market sentiments is also endogenously determined. So it creates endogenous waves of optimism and pessimism. And de Grauwe has shown that governs the business cycle, the impulse response of the output gap. If you just simply read this de Grauwe's lecture, he has shown that completely in the Keynesian tradition, market sentiments or the animal spirit matters. That governs the business cycle. So this is exactly what I said over here. I have endogenous waves of optimism and pessimism that governs my business cycle. This is your behavioral expectation. Rest of the model is absolutely fine. The way we derive our Euler equation, everything, it is no longer this ET in the Euler equation, rational expectation. I changed it to ET tilde, behavioral expectation, and I'm calculating it in this fashion. Because not only de Grauwe, even Woodford is also now is considering this kind of modeling because the agent knows everything. With all the available information to him, forecasting, rational, they're actually raising question that we have cognitive limitations, but we correct it. And as long as your rational expectation can match the data, nobody obviously raised that any question. But the sticky price rational expectation new Keynesian model, major two flaw is basically this non-Gaussian kind of distribution cannot generate. It cannot generate hum-shaped response. Mankiw and Rees, when they introduced sticky information new Keynesian model, this second part they explained, they actually generate this hum-shaped response with a backward kind of supply function. But still, that non-Gaussian output and inflation distribution. Rational expectation cannot generate that because rational expectation assumes the error are basically coming from a normal distribution. And that property the model borrows. Here, definitely, the error that we have actually assumed, demand shock, supply shock, coming from normal, but these alphas, they are non-normal. Model borrows that property. As I said, alphas determines animal spirit. That governs my output or business cycle. So this model can generate hum-shape response and also the non-Gaussian property of output gap and inflation rate. That is why this model is getting popular. Still, it will take much a bit time because rational expectation is the strongest paradigm for a long period of time. Oh, maybe you need another Bob Lucas. Woodford can be a Bob Lucas here because he is actually advocating it. Anyway, that your question. What is the optimal? Here, our objective is pretty simple with that model. And obviously, there is no analytical solution. As you said, this expectation formation is extremely nonlinear. Behavioral model does not have any closed form solution. You have to rely on computer programming. So here, with this model, our objective is to choose this omega, duration of the bond, and tau, the tax rate, income tax rate, that minimize this loss function. And this is my standard deviation. Behavioral model does not use the loss function. We have this standard new Keynesian et minus 1 yt square plus lambda pi t square. This conditional expectation, they do not use that. Entire behavioral model, they use this kind of loss function. Why? You have a distribution of output and inflation. When you are minimizing this, the standard deviation, what you're actually doing over here, you're actually choosing your omega and tau so that the extreme events of output and inflation that gets minimized. That means you are actually trying to obtain a distribution of pi and y which has a short tail, not a fat tail. That's basically the intuition of this loss minimization, standard deviation. So what you are doing over here intuitively, you are choosing your omega and tau. It is influencing the animal spirit in such a way that is influencing my standard deviation of output and inflation so that the extreme events occurrence, the possibility gets minimized. That's the intuitive way of explaining this minimization of loss function. We have done it numerically. In fact, Orpon has done it numerically. It is, I'm not that much, you know, comfortable in programming. I know some programming, I did it. It's young people like you're much more familiar. So when I done this, parameters we have taken directly from the degrowth paper. We have no change, nothing. Directly coming from the degrowth paper. When I do our loss function minimization, this is exactly, let me my silent mode. Both. And that captures in this bond structure, omega captures both. It has a proof. Your duration is nothing, is basically negative del log return divided by del log bond price. That's basically your duration. Interest sensitivity of price. And it is a proof that in a Woodford kind of bond structure, omega parameterizes both. So this is we got from our data. Before crisis, the duration 3.7 years with income tax rate 28% for the US. Increased to during the crisis period, it increased to 4.2 years, and the tax rate falls down to 0.22. So these are basically our data. So for the pre-crisis period, as I said, our proportion of long-term bond in the fiscal portfolio was 25%. So I kept 25%. And the proportion of long-term bond 43% during crisis, I kept it 43%. And what I did, two different scenario. One scenario, no zero low amount. Another scenario, I am keeping my nominal interest rate to zero for initial 30 quarters. After that, it is determined by the Taylor rule. Why 30 quarters? Is basically that's basically the duration of the zero lower bound for the US, approximately 28 quarters. And I calculate omega star and tau star that minimizes my loss. What I got before crisis, 3 years, optimal omega. After crisis, 3.25 years, rising, at least rising. The problem is here. When you have a canonical kind of fiscal rule and you have a canonical kind of Taylor rule, they are predicting a huge reduction in the tax rate, optimal tax rate. Data says it's only 6%, huge, not matching. Then I thought, okay, let me redo this analysis under different fiscal monetary interaction rule. I introduced that before, fiscal dominance, monetary dominance, no dominance. I'll come to that more detail over here. They're actually playing game. It's a Kurno game. You have a no dominance kind of structure. What is no dominance? Off and off. So both my Taylor rule and fiscal rule is completely inertial under no dominance. But when they actually playing a Stackelberg game, either fiscal authority is leader or the monetary authority is leader. When the fiscal authority is leader, I have a fiscal dominance. What is that? GT contemporaneously affecting IT, but IT does not contemporaneously affect GT. That's Rajeta and Kistonova defined as fiscal dominance. And what Bigroy and Foresti has shown that fiscal dominance is much more keen to stabilize public debt vis-a-vis output gap and inflation rate. Other extreme, Stackelberg game, monetary authority is the leader. We get money dominance. What is money dominance? Nominal interest rate contemporaneously affecting government spending, but government spending does not contemporaneously affect interest rate. just simply setting zero values, I get this kind of rules. After that, Frazetta and Kirsonova estimated that, and they have got that it is the no dominance that US followed before crisis. Their paper was published in 2010, so they didn't include this crisis period in their estimation. What I did, under different kind of rules, I redo our optimal policy analysis by choosing omega and tau optimally, numerically. That's the result. No dominance, fiscal dominance, monetary dominance. As I said, we have a two different scenarios. Scenario one, zero lower bound does not bind. Or in fact, over here, they can occasionally bind because you do not know what is the value of your demand shock and supply shock. But even if it is bind, it's not persistent. It can occasionally comes to zero. But zero lower bound binding means we are saying a persistently binding, 30 quarters, 40 quarters. Okay, so these two different scenario. So this is my crisis scenario. This is my pre-crisis scenario. And if I calculate no dominance, fiscal dominance, monetary dominance, uh, for no dominance, this is what I got, and this is how the duration is calculated for Woodford kind of bond structure. Ogniru. You can actually calculate that. It is Eric Sims paper, you go, or a Cochrane paper, you go. He has derived it. Maculae duration depends on omega in this fashion. Let me come to this over here because it will make the entire discussion much more comfortable. So Jth period is basically your pre-crisis period. J prime is the crisis period. You're actually moving from pre-crisis to the crisis period. Suppose in the pre-crisis period, you have a canonical structure. Fiscal rule, Taylor rule. You go over here, in the crisis period also you are following canonical. This is the percentage change in the duration, 8.33% rising. Tax rate is falling 20%. Remember, 0.05. Most closely, you are following canonical in the pre-crisis period, and in the crisis period, you are following a monetary dominance. Omega rising or the duration rising 16.67%. Close to data because data is predicting 13.51%. Data is predicting 6% reduction in the tax rate, predicting 10% reduction in the tax rate. Same results comes, you have a no dominance in the pre-crisis period, but you are following monetary dominance in the crisis period. So from here, we can predict that in the crisis period, definitely US is following AMD. Pre-crisis period, US is either following CN or ND. Remember, Frazetta and Kistonova from their estimation predicted that US followed ND pre-crisis. Is matching with our theoretical prediction, either CN or ND. But what new over here, that estimation for the Frazetta and Kistonova stopped pre-crisis. My analysis allow me to go for analysis for the crisis period also. And I'm predicting US is following MD during the crisis period. What is the intuition? I go for this Frazetta, DeGroy and Foresti 2023 paper. As I told you, they show that monetary dominance, the objective is more to minimize the or to stabilize output gap and inflation rate. For fiscal dominance, objective is more to stabilize public debt. Our loss function depends on the standard deviation of inflation and standard deviation of output. So in the crisis period, definitely you are much more keen to stabilize output and inflation, unemployment rate, rather than, okay, I'm giving a little bit of leeway for my public debt. And that clearly shows that MD is the rule, has to be the rule. And our model is predicting that. You are actually, so this is the support I am getting from Pradetta and Kirsonova, and the intuition that why MD, I got it from Degrue and Forestry paper. So what it basically says that if your zero lower bound is persistently binding for let's say 30 quarters, definitely your QE should be conducted with a higher duration long-term bond. It is optimal, and you should have a expansionary fiscal policy also by reducing taxation, matching with the US data, and matching with your intuition that it is the price sensitivity of return or the duration of the bond matter. It is like the optimal bond. So what I'm predicting over here, beyond risk minimizing, it is also optimal to conduct QE through higher duration long-term bond when your zero lower bound is persistently binding till 30 quarters. Next, we did also some counterfactual analysis just to check if my zero lower bound is binding for a longer period of time, is there any change in the optimal bond and optimal taxation? So I extended to 35 quarters, I extended to 40 quarters. Till 35 quarters, this result is actually coming true. Your omega higher, conduct QE through higher duration long-term bond, and you have a expansionary fiscal policy that reduces taxation. But this result got reversed when the zero lower bound is persistently binding till 40 quarters. This is what I explained already. This is what I got. First of all, when it becomes persistently binding, we see that omega actually falls down. It increases to, let's say, uh, 3.25 or 3.50, initially from 3 to 3.50, from CN to MD or ND to MD. From 3.50, it falls down to something like 2.25. Omega actually falls and tau rises. So what it is predicting, our counterfactual analysis, what US has done is perfect because it was 30 quarters. What US has done, our model is actually supporting that. But had it been a 40 quarters, this conducting QE through higher duration long-term bond and the expansionary fiscal policy is no longer an optimal policy. And the intuition coming from our 2018 IJCB paper, and also Egerton and Woodford, that tradition, who actually studied, as I said, this forward guidance. The major outcome of those research is that if you keep your nominal interest rate at zero longer, you are actually exerting additional stimulus to the system. So here, when I extend my binding zero lower bound from, let's say, 30 quarters, 35 quarters to 40 quarters, we are actually exerting additional stimulus to the system that will raise my output and inflation. Then we have to balance that additional stimulus through an optimal combination of this unconventional monetary policy QE and fiscal policy. If we are already giving an additional stimulus, the stimulus from these two combination has to reduce. This is getting reflected in your contractionary fiscal policy, and lower omega. So when you are keeping your nominal interest rate longer at zero, additional stimulus you are already giving to the system, you have to balance it with the appropriate combination of fiscal policy and monetary policy. What our model is predicting, that appropriate combination is go for a contractionary fiscal policy, raise tax rate, and conduct QE through long-term bond who has some lower price sensitivity of return. This is our counterfactual. So the optimal policy choice depends on how long your zero lower bound is binding. So this is another result. So three result. One result is it is not only risk minimizing to issue higher duration long-term bond, but it is also optimal from a macro point of view. Second is fiscal and monetary policy interaction. It has a structural shift in the US from either CN or ND, canonical or no dominance in the pre-crisis period, to monetary dominance in the crisis period. And third, your optimal policy choice depends on how long your zero lower bound is binding. It is not always expansionary fiscal policy or conducting QE higher duration bond. So this is our paper. So that's three result. And from the contribution point of view, again, I am saying from the modeling point of view, I've introduced this Woodford kind of bond structure to the model and extend this degrowth and forestry also to zero lower bound. But the interesting part is what is our future plan? Recently, there is a IJCB paper 2024. The limitation definitely that household is not holding bond. Definitely the limitation. I made this simplifying assumption just to so that our demand equation and the supply equation of degrowth and forestry, I can still use it. But I have to relax it. And what the way I want to relax it, household not only hold bonds, but household enjoys utility from the bond return. The convenience yield. This is basically another very emerging finance topic. This paper actually introduced this convenience in the new Keynesian model, modeled it in a new Keynesian way. There's a finance way of analyzing it, and this Buffo paper, they introduced it in new Keynesian structure, simply by assuming household utility not only depends on consumption and leisure, but also the bond return household is actually enjoying. This is what I am trying to extend our paper for the future, that household is holding bond and enjoying utility. If it is so, then in the light of this convenience yield, does our analysis, does our result of this omega and tau still holds? If I allow that, that's basically the future extension. So this is basically our paper and the presentation. As I told, we have just written it down. Revisions are going on, language editing is going on. Maybe you are going to send it for the publication in a couple of months. First time I'm presenting it. So comments are welcome. I hope I explained it and you understood. I do not know. I know it's a very hardcore macro paper. Hardly a very handful of people does this hardcore macro in India. I also do very less because if you really rely on doing only hardcore macro, you have to wait for your promotion for an infinite period of time. So since I have this another, I have second field, econometrics. I'm actually deciding what to do in econometrics or macro. Then I thought that if I miss macro being abroad, I cannot pick it up later. So I chose theoretical macro. But after coming back in India, I realized if you do only theoretical macro, your assistant professorship will be 50 years. So you have to balance it with your empirical also. So that is why that, as I said, this subnational nightlight, this is basically the new interest area. I initially started this analysis with my geology friend because I didn't have this expertise to process. They process, one of my student learned it, and we have this paper, this flaws paper and everything, scientific reports paper, water quality. So this is basically the empirical part. I am also doing it. But I cannot really, this is basically my first love, theoretical macro. And also you have to need student who has interest. Orpon has interest and Orpon has this statistics very form. So we venture. Comments. Mhm. Just assumption. I just assume 3 months short term and anything other than 3 months long term. Could be. But in this paper, I assume it is 3 months. We can play with that, definitely.
I was just wondering, your results is that if ZLB, if it is binding for a higher period of time, like more quarters, 40 quarters or more than that, then your optimal duration for conducting quantitative easing, that is less. Right?
Yeah.
I was just thinking whether expectations has any role to play in this because when you have a higher zero lower bound, then oftentimes you expect, because of investors' expectations, yields would be more depressed, right? And because of that, that would have its effect on the duration, right? Because the present value of your
It's the same intuition I have given.
cash flow that would
When I say that when you keep your nominal interest longer, you are actually exerting additional stimulus. This is the additional stimulus. Your yield is depressed for a longer period of time. People start, yield will depressed, and when the yield depressed, the additional stimulus coming from the expectation side only. This is how your forward guidance group of people they analyze it. That if you keep it longer for a long period of time, you are actually influencing people expectation.
right.
Additional stimulus.
Inner duration would be more if your ZLB is by
No, it is ZLB duration.
yeah.
It is that is why in my paper I didn't use duration of ZLB. I used the term length of the ZLB. Duration, when I'm saying duration in this paper, is duration of bond. And ZLB longer means the length of the ZLB is rising. So that people does not get confused. I didn't use this duration of ZLB in this paper. When I'm saying duration, duration is bond, omega. So when the length of the zero lower bound is rising and beyond a certain level, additional stimulus, duration of bond falls, that you are conducting QE with some lower duration bond whose price sensitivity of return is lower. And not only that, you shift it to a contractionary fiscal policy just to balance this additional stimulus.
So you're finding that the optimal duration is falling.
Falling. Definitely, I cannot match it with the data. It's the counterfactual. The till I can match the data, our result is matching with the US. So keeping that in mind, my analysis is correct. I extend the same model with a lower duration. It's a prediction.
So when you have done your simulation, you have looked into data for different, like a number of bonds, right?
Yeah, actually, I have not calculated. We have taken it from Greenwood 2014 paper and Sargent's paper. They have calculated this duration of bonds for the US. We have taken it from them. Even this tax rate, Tronband and Ulick paper. They have calculated it. We have used it for the US paper. So we have not calculated them. We have just matched them.
I was just thinking the duration is heavily reliant on your coupon rate as well, coupon rate and maturity. So they have to be comparable across these different bonds.
Yeah. So they have done it. We have not done it. We have not done it. We have tried, but we find that we do not have this expertise to do it. So they have a way of doing it, these finance people. So we have borrowed their calculation and done our analysis and checked whether it is matching or not. And it's from percentage rise, percentage. One thing is clear that as long as it's 30 years binding, all this fiscal monetary interaction rule, they are saying that your omega should be higher. In US, a higher omega. Then we said that, okay, which one is matching more closely? In fact, over here, this Tronbrat and Ulick, one of his paper, they said that, okay, fine, in the pre-crisis period, it was 28% labor income tax, but labor income tax falls down to something like 20%, not 22%, another extension. So it's a 10% reduction. If it is so, it's perfectly matching with our reduction in the tau, 10% reduction. So for till we can match it, our model is performing well. So relying on that, I extended the counterfactual. Let's see whether the optimal policy choice at all depends on the length of the zero lower bound or not.
There can be another compromise. You think it's from 30.
Mhm.
Now you are using 50.
We have actually done it for 15, 20, 25, 30, 35, 40. For till 35, omega rising, tau falls. 40, reverse.
So related to that, I was
Mm.
with the logic of having a big enough length, like 40, was saying that that high length or longer length is giving a stimulus to the
Mhm.
economy itself.
Mm.
And to sort of counterbalance that, you have a stricter fiscal rule and monetary. That is basically that.
Mm.
But why is that logic not operating before you reach that sort of critical point? For example, if you're going from 25 to 30 also, you are basically easy, right?
Yeah. This 30 is actually coming from the data. For the 28 quarters, US actually had zero lower bound binding. That is why my initial analysis with the 30 quarters binding. So I am not choosing it. US is guiding me. They tell me if I am 30 years binding, whether omega is rising or tau is falling on me. The thing over here is, as I said, that group of paper, this forward guidance paper, their main objective was to find out that, okay, I'm artificially keeping this nominal interest rate longer for a more period of time. If I do that, they realize there is a stimulus, loss minimization. Now the question is how long? This group of people actually have calculated how long. This Adam Billy, Egerton and Woodford, Zhang Teranishi and Wharton Bay. And our contribution to that literature was that if you can choose your inflation target properly, just through your Taylor rule, you can match their result. That was our IJCB paper. But that intuition helps me to explain this, that why the reverse is happening. And that is why after seeing this, we actually said, okay, you keep on doing it. There's 15, 10, 15, 20, 25 to 35, it's fine. It justifies that what US has done, conducting Q with the higher omega and reducing tau, is absolutely optimal. But had it been 40, my model is suggesting that you should not follow the same policy. Optimal policy changes.
just one strong point. I'm not familiar with
Mm.
it. Just my questions might be naive.
Mm.
So this ZLP thing, you try to match with the US data, but I thought that in the case of Europe also, they hit the ZLP at some point of time after the crisis.
Mhm. Almost all the central bank did it.
So did you try to match your model with their?
No, I didn't. But the same thing can be extended. Just you choose your different mu, that is the proportion of long-term bonds, and choose different T hat, your length of the ZLB.
Interesting for the UK, because for the UK there is the prolonged ZLP,
Okay,
quite similar to that.
maybe.
Just to check.
And another interesting part is for this calculation of this duration, as I said, we borrowed it from Greenwood and Sargent. This calculation is only we found for the US. As I told you that I tried that. Okay, I told my research scholar that try for it, but we leave it. It is not our expertise. It is a very core finance area. So if any finance guy can give me that calculation, I can use my model and check whether our policy prescription is matching or not. So that is why the macro paper, and now every paper nowadays, single authored, impossible. A lot of things are coming. Even our this nightlight thing, I had to take help of our geology people to teach us that how to process satellite data. So they came, they teach us, and then once we are familiar with that, we tried analyzing. Initially, they analyzed with their water quality and everything, and then I got this poverty, crime. That's our PLOS paper.
Question. Think how your at here logistic
Mhm.
that is means we should change it to simply taking suppose the share.
Simply by checking.
Now what we have done, we have transformed it into exponential and then have determined the share.
Share, yeah.
Instead of that, we take simply the U.
Simply the
U, your utility, negative utility that you
okay.
without
No, it's basically as I told you. Here I have simply followed de Grauwe. I have not done any changes in this in that modeling, in expectation modeling. And why de Grauwe did it? Data gives me a non-Gaussian distribution of inflation and output gap. With this kind of logistic distribution, calculating the share, he can match it. Even these parametric values, he, as I told in my simulation, I have used the parametric values of de Grauwe. I didn't change this because these results are extremely sensitive to the parametric values. He did all kind of simulation to identify which parametric values can match the US data better. I use that. So it is kind of standing on the shoulder effect. A lot of things has been done by de Grauwe, a little bit of extension, even the intuitions coming from that. He has a series of paper actually. He started working with this particular area in 2012, and now continuously he is publishing. And Woodford, that cognitive limitation, that somehow they're obsessed about this thing now, that human being has cognitive limitation, and I have to capture it in my model. Thank you very much. Thank you very much for giving me this opportunity to present such a hardcore, boring topic. So,
theoretical right now. Somewhere I think